Welcome to Geared for Growth. I'm your host, Mike Mortlock. Now today we have the wonderful Dawn Fouhy, who is coming back on the show, and she came on the show a little while ago, but I wanted to get her back as a big thank you to supporting the charity bike ride I'm doing in Thailand next month for Hands Across the Water, which is a charity that benefits orphaned children in Thailand. So a big thank you to Dawn for her generous contribution there. But she's also given us a generous contribution in today's episode, where we're talking about buying in Victoria 101, essentially. What is different about buying in Victoria or Melbourne, say, compared to Queensland? What do you need to know about your pest and building, about the contract, about due diligence, about minimum standards and land tax, and some of the other things that go along with owning an investment property in Victoria? Now, why are we talking about this? It's very clear, both from sentiment and anecdotally from buyers agents on the ground in Melbourne, from Facebook groups and forums, that Melbourne has become very attractive, of course, for its fundamentals, its price point. We also challenge some of the ideas why Melbourne might be the next hotspot, but this is a great insight for anyone that's looking at Melbourne and wanting to make sure that they are protecting themselves and transacting on a quality property. Dawn also shares some of her hot suburbs that she thinks have some great investment potential. Again, it's a wonderful episode with the wonderful Dawn, and here it is. Dawn Fouhy, welcome back to Geared for Growth.
Thank you very much, Mike.
We had you on, I don't know, weeks, months ago now, where you were sharing some really good tips and insights into property investing in general, and research and data, and getting decisive and taking action. But today we've got a very laser focus on the Melbourne property market. Why Melbourne? Well, that's the big question, isn't it? Because a lot of people are looking for the next Perth. And whilst they might not necessarily think that Melbourne's going to do those sorts of numbers, it certainly has been underperforming. If you look at the data, which thankfully I have here, since March 2020, the Melbourne market has done 7.8%, whereas Perth has done 76, Adelaide's done 73, Brisbane's done 68.2. So it begs the question, is it the next market? A lot of people think yes. So we've got you here today for a beginner's guide to transacting in Melbourne, everything that we need to know. So I'm very thrilled to have you today.
Thank you so much. Yes, and yeah, they do let us out of the house in Melbourne now. So yeah, it's pretty good.
So, catch us up to speed on sentiment from your perspective, because we just had that 25-point basis cut from the RBA. I'm guessing that you were having quite a bit of inquiry already, but that may have put a bit of fire under the backside.
Yes, definitely. But I think what has really shocked me is seeing the data play out in real time. So going to open homes and seeing the level of first home buyers and second home buyers out in force. So we really focus on the sub 800K market in Melbourne. So, and I think you spoke about Perth and Brisbane. It's important to remember that affordable markets in Melbourne begin at 600K. So it's not like when you're buying in Perth originally and you were able to buy 400,000 and have a rent of 550. You're buying in a very different marketplace with a starting price point. I would say the cheapest kind of house on land established that you could get in an area with a low vacancy rate is about 580,000.
Which is still very cheap, isn't it? I mean, it used to be the case in Perth, it used to be the case in Brisbane. Maybe there's pockets of Adelaide where you can do that. But with our data for 2024, we found the average amount that property investors were spending was 650,000 there or thereabouts. And it begs the question, well, where can you go for that? And to be able to go to what will be Australia's biggest capital city in a handful of years, it's pretty incredible.
For sure, because if you look at anywhere within, Sydney CBD within that 25-kilometer radius, you're looking at houses from 1.2 to 1.5. In Melbourne, they're half that price. Now, Like, and that's very speculative. So we don't want to get speculative that just because an area, has only done 7% over the last 4 years, that it's going to grow and it's its turn. That's not how investing works. So, we still have to look at the fundamentals, at the supply, the demand, and the building approvals.
I'm very glad you said that, because there is a lot of, well, I mean, I suppose if we were plumbing into the zeitgeist of the Melbourne centric investor, they're kind of thinking it's its turn. It's all about this mean reversion, right? And mean reversion is, it's a financial theory that has definite merit, but it depends on the time frame. And then there are also times where it's not applicable. You think about, say, investing in tech stocks. There can be a fundamental change to technology that throws that out the window. We could be looking at Melbourne, that's approaching a 200% debt to income sort of metric. That is a fundamental change to the way Melbourne might perform forever. So we don't just want to go, it hasn't done anything and everywhere else has, so therefore it's a sure bet. So I'm glad you mentioned that, because I was about to tick that off as well.
Like 100%, because the last thing we want is anyone to lose money, and it worries me that people will come investing in Melbourne with the same logic that a rising tide will lift everything. That's not the case in Melbourne. There's suburbs that are still dropping, that have an infinite amount of supply, that the market is not absorbing the stock. So you just don't want to, like, example, like in the north or the west, there is suburbs like, like Beveridge, that has, building approvals of like 5%. So there's places you need to be really careful of investing in Melbourne. It's not the case where when Melbourne starts to grow, everywhere will start to grow and outperform.
Yes, but we do want to hear about some of those suburbs that you believe that do have the fundamentals, as much as you're willing to share your secret herbs and spices. But to get to the thread of the show, it's investing in Melbourne for beginners. So
Right.
depending on where you buy around the country, there's different rules about whether you can waive the stamp duty, how you can have your finance clauses, when insurance needs to be in place. And then, of course, there's the ownership, there's the minimum standard stuff that you guys are quite famous for. There's the land tax one that is the real elephant in the room. So how do we start? At what point do you see a deviation from different states, or at a point where anyone that you are educating that is going to transact in Melbourne, these are the things you need to know that are Victorian specific?
Okay, so if you're coming from Queensland, let's talk about building and pest inspections and what you can expect to negotiate on. So in Melbourne, you only have rights to exit a contract if there is a major structural defect. Now, again, this will be something to talk to your conveyancer. So if there's like 100 minor defects, it's up to the seller's own discretion. They don't have to give you anything. They don't have to discount on the price. You take it or you leave it. So that's one thing to be very mindful of. Now, talking about the minimum rental standards, the compliance that's in place in the state of Victoria. So one that we've really noticed in the last few transactions is in a living area, in the living area, you need to have a heater that is above a 2-star energy rating. So if you're buying an older home and they have those old big gas heaters on the wall, they are not compliant. So you will be requested, and the cheapest option is to put in a split system to make it compliant. You need to have gas compliance, electrical compliance as well. That's at a high level. Now, you can look at this one of two ways. You can say, oh, this is painful, it all sounds a bit much. Or you can think to yourself, okay, my job as a landlord is to make sure my tenants have a house to live in that is up to those standards. Those tenants may stay for longer, and it's just protecting your asset. So that's just one point to is different.
Yes. And I mean, that is an ongoing cost as well, because you do have to maintain that compliance, right? Like, it's not just you need to have the things in place at the beginning, but you have to have the inspections on that and, things like the gas and those sorts of things. So what else do we need to know about the costs based on those minimum standards as an ongoing thing?
So I guess it's a really good time to be a compliance company in Victoria. So,
Mm.
there's definitely a lot of coin in that. It's every 2 years you need to have your gas and electrical checked for that. But remember, any state can change their tenancy laws at any time. So
Mm.
in Queensland recently, they brought in where you had to have blinds on every single window to be able to tenant out your property. So I think that when we're investing, if you always keep a focus that yes, you may be able to make equity short term in some markets, but investing is a long term game. And I think people got very probably delusional over COVID, seeing all of this, 100% growth in 5 minutes, and
Mm.
yields of 8%. So that's not what investing is normally. So yeah, it's just important to remember what market you're investing in.
Absolutely. It's a get rich slow program, really. Of course, we want to time the market if we can, but it's time in the market that where you get those real strong compounded results. So, pest and building, we've done the compliance. What about signing the contract and the things that we need to have in place that's different from, say, Queensland?
Really, really good question. So the first thing is you need your offer to get accepted. Now, what you need to know about Melbourne. So you're looking online and you think, wow, the quoted price is 550 to 600. We are an auction state. You will see that most stock goes to auction. Off markets are very rare. And if they are off market, normally it takes a lot of due diligence to make sure they actually stack up. Now, if you see that property advertised 550 to 600, add 10% on to the top end of the range. That's what you can expect it to sell for at an auction. Private sale, same thing. I would add 10% on top of the top range so you're not wasting your time. There's enough volume of transactions for you to be able to do your comparative market analysis. However, the markets have started moving. So we were buying in Frankston North in the 580s in December. Now in February, things are selling for 660.
Wow.
So this is in a market that has had negative 3% growth in the last 3 years and has only grown 1% in the last year. Stock on market is like, I think it was last when I checked, 0.2%. And the vacancy rate is 1.7. Now, talking about investing in Melbourne for beginners, there will be areas where there's a really high vacancy rate, but the data is good. So you need to weigh that up, okay? So when you're investing in Melbourne, can you afford your rental to be vacant for 8 weeks? Because in some areas, especially in the sub 600 price range mark, areas that are like 20 kilometers to the city, you may be waiting 8 weeks for a tenant.
Which is not something that we're conditioned to really understand, given the national rental affordability crisis and vacancy rates nationally being in and around 1%. I mean, even 1.7% in Melbourne is categorised as a tight market. I think the consensus is anywhere around 2 to 3% is quite balanced, but we're now hearing 1.7 and going, oh, that's high. It's not really.
No, not at all. So 1.7, about 2 weeks to rent out the property if you have it priced well. So another Melbourne tip, yes, the yields are lower here, but again, you're buying in a market where over the last 5 years, there's only been 30% of rental growth. So what we're seeing as well, which always doesn't surprise me, but I'm still seeing a lot of landlords selling out of Melbourne now. And I'm seeing first home buyers buying that stock. So I'm actually seeing vacancy rates in real time dropping. And I am seeing more pressure on rents.
That's an interesting one. We're in the middle of a research project that hopefully will be released this month, and it's showing that 13% of listings were rental properties, which is actually quite comparable to New South Wales. But of course, there hasn't been the amount of investment in Victoria to stabilise that, because you can have 13% of listings being rentals, but you get lending commitments for investors through the roof, you're still heading into positive territory. I actually did a a Melbourne special on the Property Trio podcast the other day, which is why I've got this little piece of paper. And there was a little bit about yields in there. As recent as 2023, Melbourne's average rental yield was 3.3%, a full 1% below the average Brisbane yield of 4.3 and 0.7 below Adelaide, which had an average yield of 4% 2 years ago and has surpassed them both. An extra 1% yield on a property at $1 million is $10K a year. So it's meaningful, right? Even though we're talking about a lower price point, even $5,000 a year is meaningful.
Exactly, which is really more vital that you're investing in the right suburb. So, as I mentioned, some suburbs are starting to move. I want people to really get into the suburbs that are starting to move, get into the affordable markets first. So, I think with hopefully more rate drops as the year goes on, we may then start to see the second home buyer market move, like the kind of like 1.5 million plus. The $2 to $3 million market in Melbourne has seen the biggest drops. The affordable market has remained steady, and we're definitely seeing more pressure on that market.
Yeah, and I think that's fairly uniform across the country as well. The top quartile has dropped fairly uniformly. I think there's maybe a place like Canberra that it bucks the trend, but Canberra's weird. It's full of politicians and public servants. But yeah, the affordable markets have been holding firm. They're either getting the majority of the share of growth, or in a declining market, they are holding firm. So there's a lot to be said about that kind of price point, because I was interested if you had a thought. Is there a sort of a price point where you kind of think, yes, I can buy, but I wouldn't because of the quality of the asset?
The Geared for Growth Property Investing podcast is presented by our business, MCG Quantity Surveyors. If you're an investor or a property professional looking to get the best tax depreciation deductions for yourself or your clients, please get in touch with us at mcgqs.com.au. It's our mission to help as many property investors as we can to maximise their claims and maximise their property education as well.
Yes. So I think just with the compliance standards and just with the cost of developing, I think we're of the ethos of timing the market, and just letting the market do 80% of it and figuring the rest out at the end if you want to sell or you want to continue to hold. I think that, to your question, where we're seeing the most value at the moment is the 650 to 750 mark.
Yep.
But we're competing with first home buyers and second home buyers and a few sophisticated investors. Now, it's really important to mention that the investors we're seeing selling out of the Melbourne market are investors who've held here for 20 years. So They're consolidating, they're buying their commercial property, and they're like, can't be bothered with compliance or whatever else they're doing. And they've seen the doubling and doubling again in that time frame.
Yeah, because it sort of begs the question, well, why would you sell now when it kind of seems at the bottom of the market? But if they've held it for 20 years, they might have spent $30,000 to get it, right? So if they're selling for $650 or $750, they don't really care. It's about moving on to the next stage of life.
Like 16 years ago, I think one property we were looking at off market, the guy bought it for 200,000, and then it was looking kind of in the low 700s 16 years later.
There you go.
So that's property, so.
So we've talked about the ways that you can exit a contract. What about things like cooling off? How does that differ?
So with the cooling off period, it's always best to check with your conveyancer, of course. But as far as I remember, it's like 3 to 5 business days, mostly 3 business days. But you will have to pay a percentage cost to get out of that cooling off period. Normally, it's like $1,500.
Yeah.
So just make sure that it's normal to get cold feet and be scared when you're investing. But yeah, it'll cost you money to get out.
Yeah. But it's kind of speaks to the value of having a team. If you engage an advocate or a buyer's agent and you have a good solicitor or a conveyancer, it's their job to guide you through it and protect you, of course.
Absolutely. And I think as well, especially if you're an investor who's been buying in regional areas, um, the market isn't as sophisticated. The market in Melbourne is very competitive for real estate agents as well. So, and they're very well like governed, and they really run very slick operations. So they are master negotiators. They are trained really, really well. And yeah, it's been really amazing to be involved in amongst those transactions, because yes, the real estate agents in Melbourne are of a real different caliber, and you could be their job is to work you, so just be prepared for that. And the off market culture is not really here,
Right.
which is interesting.
Yeah, that is an interesting one. And I think it also should be said that off market doesn't mean below market or cheap or a good deal, right? I think that's been a fairly pervasive notion amongst investors, that off market, it's even been an advertising point for buyers agents. Like, we buy 60% off market or 90% off market. And it's kind of like, oh, well, those are just words. Like, you really need to tease out, well, why is that the case? And what are these types of properties? And is there never a deal that's on the market that you would put in front of an investor? Where do you sit in that?
I sit in that kind of on the fence. It all depends on the deal. Like, we're very picky, I guess, because we can be. So we're a small agency and we only take on a certain number of clients a month, because our whole thing is to like build portfolios for people. And I think that really just comes from when I was a nurse. I used to be an ICU nurse for like 12 years. I really wanted that sense of purpose in property as well. And the real thing for me with that is getting freedom for people from investing. So good enough for us is not good enough. And that's why like our sourcing team get a hard time every day, because we're like, no, 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 no. And then I'm going out to like opens and talking to agents, and I'm like, no. So yeah, most of the time it's we just don't settle. Like, I want to be able to go to sleep at night knowing that anything we've bought is going to outperform, because otherwise, what's the point?
Absolutely. And I think the greater the size of the business, the harder it is for the founder or the person that's got their name on the door to be as connected to the deals, right? Whereas you're personally across them. And I understand and appreciate that's a big part of your ethos, as you say.
100%. Like, I'm one-to-one with the clients. So we had opportunity to scale, at numerous times. And it was hard to kind of say like, no, I don't regret it, because it's hard as it is to, maintain a quality standard and have a business that's working. So for us, we never wanted to compromise on quality. And like, mad respect to anyone who's built like, a huge buyer's agency. I just imagine it would be really difficult to have quality controls if you're transacting 80 plus deals a month.
Fair enough. Now, for the people that are thinking, geez, I like the look of Melbourne, but this bloody land tax thing, I'm scared about it. I don't know how it works. How much am I going to be up for? What do people need to know?
Yeah, it's about 200,000 a year. I'm sure.
And cut.
Yeah.
We've just tanked the market.
Yeah, basically. No. So it's about $2,000. So if you're looking at those kind of purchases, 650, it's about $2,000 a year. But your insurance in Melbourne is $800 a year. I'll tell you, a personal property, investment property we own in Annandale in Townsville, our rates every 6 months are $3,000. Our rates to hold that property are $6,000 a year, and our insurance on that property is $2,500.
Cyclone Alley, right? I mean, that's the difference.
Correct. So whereas, yes, you pay a land tax in Melbourne, but you also pay a land tax in Queensland if your land value is above 600,000. So Be under no illusions that any policy can change at any time. And if you're investing based on policy, you'll never get to where you want to go. I always just focus on what I can control, and that's how much money I can make on the way into the deal. And that I'm picking the right market that's going to run and that we can make the most amount of money in.
And I suppose what is kind of quite different to other markets is the threshold for where land tax cuts in, right? Where you can go to other states where there might be, a threshold where the land value on, say, a 650 purchase, it won't hit it. But in Melbourne, at $50,000, that's every bit of land, right?
Yeah, you can own a pothole and you'll have to pay land tax on it.
Yes. But as you say, it's a cost of doing business, and you have to weigh it up from a cash flow point of view. Is it worth doing this? And I hear the argument about people saying, oh, I don't want to buy remotely because then if they need a light bulb changed, I can do it myself instead of paying, $2,000 for someone to do it. And I challenge people to say, okay, well, what if that particular market does 2% and the one that's remote does 8%? You're getting to the point where it's worthwhile to pay $60,000 to change a light bulb, which of course nobody's quoting that. Although I don't know, tradies are getting up there, aren't they? But I think we zero in on some of those things. We zero in on the negative of land tax or, the issues of maintaining a property that's a million miles away, but forget in the broader scheme of things. And when you're analysing the finances of it, these things can pale into insignificance compared to the upside, right?
Correct. So like if you're buying in Melbourne now in areas that have done nothing for the last 3 years or over the last 5 years, they've only done 20%. Like you buy something for 650 and that's 900,000 in the next 4 or 5 years. Like that's a pretty good result as far as I'm concerned for doing nothing to the property.
Yeah, exactly. All right. So what else do non-Victorians or people that maybe are Victorian but haven't transacted on an investment property need to know? Have we covered most of it off?
I think so. I think as well, auctions can be, scary if you're not used to doing auctions. So you should know if you're purchasing at an auction that it is an unconditional purchase. So you buy in an auction, it's your property. No finance clause, no building invest. So always make sure you do your due diligence and you're fully pre-approved before bidding at an auction. And as well with the yields. So this is what I wanted to talk about as well. So talking about, rents potentially going up, you need to factor in, you will be out of pocket in this interest rate environment around $350 a week, pre-tax and pre any depreciation.
Yeah, of course we can help you there with with the depreciation, but yeah, of course that is something that people need to know, because if you look at the stats, we're still looking at around about 72% of property investors only own one home. I contend the reason why that stat is so high is because many people get the first one wrong. And if you get yourself into a position where you can't maintain that negative cash flow and you're forced to sell, there's no real way to make money. Even if you're pretty clever on getting in, you've got the stamp duty, you've got the selling costs, and you've got the emotional distress of that. And I think many people that get in that situation, they just kind of go, that's it. I'm hanging on by the skin of my teeth. And this will be all I ever do, or I've had to sell this one, and I don't know, crypto seems safer now.
100%. And, because if it costs you your peace of mind, then the price is too high. But I can talk to, what we're doing with our own personal investing as far as our self-managed super fund. So Melbourne for us is a no-brainer for SMSF because it's right at the start of its growth cycle. So, and again, this isn't financial advice. This is just what we do personally, is that within our super fund, we focus on markets that are about to start their run. And then once they've finished, we will sell, realize that gain, only pay 10% CGT and roll into the next market.
Yeah, right. Awesome. Let's talk about those secret herbs and spices locations that you've got your eyeballs on. Now, I saw a comment on a Facebook group the other day where they were diving into Melbourne, and you're like, oh gosh, don't give too much detail. It's already tight and difficult. So I'm aware that you might want to keep things close to your chest, but where can you sort of point people to that particular price point where there isn't some terrifying things that just people wouldn't be aware of that would make you swear off that location?
So I think an area that is really well-rounded and that you can't go too far wrong, as long as you're aware of where public housing pockets are, is Frankston. So Frankston is divided into really three parts. You've got Frankston North, Frankston proper, and Frankston South. So Frankston's median or typical value is about 723,000. Frankston South's is 1.3 million. So that's number one. The vacancy rate is low, stock on market's low, lots of first home buyers, lots of, new kind of coffee shops opening. There was like a brewery, like beach club thing that opened there. And yeah, that's where I would kind of hang my hat on as a well-rounded area. Also, the blocks are quite big, and we bought in Frankston North for somebody a few weeks ago for 650,000. 3-bed, 1-bath, 700 square meters, side access, so enough room for a granny flat at the back, that they can just hold and ride the cycle and then decide what to do with the property. Seaford as well is really good. That property was 750,000. So again, there's different price points. If you're looking for something cheaper, I would look at Frankston North. And if you're looking for something around the low 700s, it would be Frankston.
Right. And that used to have a bit of a reputation as a fairly sort of ugly suburb, but a lot has changed and it's gentrified quite a bit. And it's actually a real beautiful stretch of coastline. No matter what's going on inland, I spent a bit of time on the waterside there, and it's actually a really picturesque sort of place. I mean, I've heard someone call it the Paris of the South. I think that was a joke, but there's a bit going for it.
It's like the Amalfi Coast, I would say. I mean, it's
for someone that's never been to the Amalfi Coast, you'll find it identical.
Oh, absolutely. I've never been there myself, but you just close your eyes and hear the dulcet tones of the local people, and you think Amalfi, and you think you're there.
There you go. Oh gosh. All right. Well, that has been a really good whirlwind tour of the basics of buying in Victoria, and thank you very much for sharing your insights in some of those suburbs where there's definitely going to be potential. Remains to be seen what will happen with Melbourne and Greater Victoria in 2025, but certainly from a price point of view, there's a lot to be looking at there compared to some of the other capitals. So thank you very much for sharing your wisdom today.
You're very welcome. And I think it will really surprise people in 2026 and 2027, given how low the stock is and the demand, where the prices will be.
Awesome. And I think for a long-term investment, you probably won't be able to go too wrong.
You can never go wrong. Think about that bloke who bought it for 200k 16 years ago, and now it's low 700s. So
there you go. Thanks, Dawn. We'll see you again soon, hopefully.
Mike.